Okay, it looks like we've got pretty much everyone signed in. So let's get this rolling. Good afternoon, everyone, and welcome to Spillane Consulting Associates' second Town Hall Forum of the year. We thank you all for joining us today, and we're excited to get started. And we hope that you find this presentation on redlining and collections to be both informative and directive as you look to apply what you already know with what we will reinforce in today's discussions. Today's presentation will be split into two parts. The first will be led by SCA's compliance consultant, Rob Ellis. Rob will take us through redlining, determining your REMA, major risk factors, and ways to mitigate those risks. The second part of our presentation will be presented by myself, Heather Pappas, and I will focus on collections and default management, walking us through some best practices, recent industry news, and recommendations for overcoming operational challenges. At the end of this presentation, our contact information will be provided along with a copy of the slides. So as always, we welcome you to reach out with any questions or concerns. And now let me pass things over to Rob to get us started. Rob?
Thank you, Heather, and welcome everyone. Thank you for joining today's topics. So what is redlining and how does it happen? A very important question. To start with today, I'm going to go over redlining and REMA, two critical items that you have to understand before your next examination. Because as my first question asks, are you prepared for a fair lending exam? And if the answer is we've never had a problem in the past, well, that's not a good answer because everything changes from exam to exam. Your data changes. The economic environment that we're in has an effect on fair lending as we have lower volume. Lower volume has more impact to percentages, and optically, one or two loans can make percentages look all that much more worse. It's important to know what redlining is and what your REMA is. They go hand in hand because redlining isn't just simply you don't lend here or market there, but it could very well be that you're lending in these areas, but the products themselves have higher prices or negative attributes. Your REMA is critically important, which stands for reasonably expected market area. Because if you don't draw your REMA appropriately, you may be missing minority areas that the examiners may consider in their exam, and you could be completely in the dark to exam scrutiny. And it's critically important to understand what your data is saying. And I underline data because data is any information that reflects your lending activity in and out of these areas. You need to review for all aspects of lending, not just the denial rates. Later in my presentation, I'm going to get into some takeaways that you can implement to help prepare and prevent redlining examination issues at your next exam. So to just kind of make the point, let's get into some recent DOJ cases to show how significant redlining cases are. And roughly over the last year and a half, there have been 6 DOJ redlining enforcement action settlement agreements. They are eye-opening. On average, each one of these had to invest $12.6 million for loan subsidies for residents of redlined areas. In addition, upwards of $1.5 million for development of community partnerships and for advertising and outreach in those neighborhoods. And 2 of the cases involve requiring consumer financial education programs, and almost all required the opening of branches in these areas and hiring Spanish-speaking loan officers to serve these areas. It's needless to say, but when there's a redlining enforcement action, it is very costly and something to avoid at all costs. So let's get into redlining. I'll go over an overview of redlining and what the definition of redlining is and what reverse redlining is. Then I want to go through the interagency redlining risk factors. These are the roadmaps to the minimum things to consider when doing a redlining risk assessment and data analysis. These are the basic items that examiners start with to determine whether or not they're going to choose a focal point of redlining at your next examination. So what is the definition of redlining? Well, it is the unequal access to or unequal terms of credit because of privileged characteristics of the residents of the area in which the applicants reside or will reside, or in which the resident's property will be mortgaged is located. And reverse redlining is specifically targeting a borrower or an area with less advantageous products or services based on prohibited characteristics. And that is right out of the interagency fair lending exam procedures. Now let's specifically look at redlining risk factors from the exam procedures and discuss each one a little bit and clarify the importance of what each one means. So first off is R1, HMDA application origination disparities in majority-minority census tracts. What this basically means is that examiners will take your data and look at your REMA and determine, are you receiving applications from MMCTs, majority-minority census tracts, and are you originating loans in these areas? Examiners have tools to determine other lender and peer data, as well as owner occupancy, to determine if you're an outlier. If this risk factor is present, then you'll need to explain to examiners why there are disparities and give reasonable explanation as to why there's disparities and that you have an action plan to address this risk. Next is R2, which goes hand in hand with R1, and approval rate differences for majority-minority census tracts. So again, examiners look at denial rates, approval rates concentrated in minority areas versus non-minority areas. R3 is reviewing the denial reason for things like LTV. Examiners concentrate on what are some of the denial reasons for applications in majority-minority census tracts compared to denials in non-minority census tracts. R4 has to do with reverse redlining, where examiners look at the differences in originations of higher price loans and loans with potentially negative consequences to borrowers, like maybe prepayment penalties. R5 is other patterns of lending identified during the most recent CRA exam. Chances are, if there are redlining issues in the CRA exam, it'll be very likely there's redlining issues in the fair lending portion as well. R6 is pretty straightforward. It's policies regarding the offering of certain credit products that are tied to a geographical area. For instance, we only offer products in this town or area, and that area is a non-minority census tract. Then it's a risk factor that examiners will need to get a reasonable explanation for. R7 and R12 are related in that examiners will look at the branch network and see where the branches are located and whether or not they're located in or near majority-minority census tracts. And then look at the services and hours of those branches or LPOs. And do they differ? And is there different staff available? What products are different by branch? This can be critical when it comes to redlining. If you have branches that aren't anywhere near majority-minority census tracts, well, then you need to explain that because you're not servicing and therefore you're probably not getting applications from these areas. R8 is straightforward and similar to R6. R9 is evaluation of the CRA assessment area. And typically, CRA assessment areas are drawn by looking at income levels. And that doesn't necessarily correlate to majority-minority census tracts. But examiners will look at the border of your assessment area and see what's just outside of the CRA assessment area. And if there are majority-minority census tracts that border the assessment area, then you've got fair lending risk. R10 occurs during any interaction with an examiner. They will ask probing questions to see if there's any preferential opinions as to locations of where better loans are, and if management or loan officers or anyone gives an opinion that there are areas that are better than others. I would highly recommend that this is something that you would never express to an examiner, that you have preferential locations. And R11 is if the bank has received specific complaints claiming redlining from consumers or community groups. And that is something that would get the attention of the regulators big time. So that's a quick overview of redlining and the areas to focus on in determining redlining risk. Next up is REMA. So what is REMA and why is the REMA so important? And how do you determine your REMA? And I can't stress how critical it is to understand what your REMA is. And it needs to really match or at least be larger than what the examiners are going to consider as your REMA. Because if you delineate a REMA that's smaller than what's going to be evaluated during the examination, then you'll be unaware of things that are going to be needed to be explained. So now we're at the million-dollar question. What is a REMA? Well, according to the FFIEC Interagency Fair Linear Exam Procedures, a REMA is the reasonably expected market area, which is a geographical area that the regulatory agency believes a financial institution can serve based on the distribution of applications and loan originations and its marketing and outreach efforts. And typically the REMA will extend beyond your delineated CRA area. And that's an important area to stress because when you look at your CRA performance, your inside-outside might typically be 65 to 70% on average. A REMA can contain upwards of 90 to 95% of the institution's lending. So it is a very large net to set. Especially in this digital age, it's much more reasonable to expect a financial institution to have a market area larger than a CRA assessment area. And why is this really important? Well, it is the basis for how redlining discrimination is determined. This is the area the examiners will look at, the demographics and economic conditions, as well as competition, and analyze the financial institution's performance in lending to areas that are majority-minority census tracts, as well as high concentrations of minority areas. So how do you determine your REMA? Well, there are several, if not dozens, of factors you should consider when determining it. First thing is to look at your CRA assessment area and just see what your inside-outside ratio is. And as I mentioned before, if it's 65 to 70%, then I recommend you are going to want to expand and look at a larger area for your redlining REMA analysis. But as mentioned before, this is one area of the risk factors you want to look at and see what borders your CRA assessment area on the basis of demographic information. And do you have any majority-minority census tracts bordering your assessment area? If you do, then a deep analysis needs to be done as to whether or not that needs to be included in your REMA. Second step is to map and plot loans and applications. And this is a good exercise to have visually plotted on the map so you can see where your dots are and if you have clusters or empty donuts. And the donuts are not a good thing, especially if you have donuts that are right over majority-minority census tracts. And donuts, for those of you that may not know, are basically gaps. There's no lending. It's kind of self-explanatory. Next thing is to overlay branches and loan production offices on the map. These coverage areas must be part of your REMA. Another big item to consider is marketing efforts. Advertising marketing programs are key in determining REMA. Another thing to be aware of is your defined market area or possibly a strategic plan that discusses market efforts and possibly geographic areas that will be concentrated on. It's important to stress that examiners will look at this and consider it in drawing your REMA. Other information to consider would be credit demand and competition, which can be difficult things to delineate. For example, you could say to an examiner, there's a ton of competition, let's say like in Worcester, Mass, and we just can't compete there, so we didn't include it in our REMA. However, the examiner is going to do analysis and see that you do have loans in Worcester and that there possibly was marketing efforts in the Worcester area. And there's a loan officer specifically assigned to a geographical area that covers a large area that also includes Worcester. At that point, you may say you don't consider Worcester in your REMA, but now you've got an exam about to be conducted, and they're going to include Worcester in your REMA. And now you're at the mercy of not knowing and probably going to be under some exam scrutiny. Next is if you have any broker or realtor relationships, as well as if you have a history of mergers and acquisitions. Make sure you properly import those areas as well. And lastly, for drawing a REMA, is locations of substantial minority census tracts. When drawing the map and plotting the map, you're going to want to know the exact demographic makeup of the census tracts in and around your REMA. Because when you draw your REMA, it's the same as your CRA assessment area. And if majority minority census tracts border your REMA, it's going to look auspicious. And you have to have ready explanations as to why they're excluded. You need to know what your border is made up of. So I want to briefly also touch upon how discrimination is determined. This is important to keep in mind when doing your REMA risk assessment. Following the same steps will help you identify risks that you'll need to review and control before an exam starts. And from my standpoint as a former examiner, discrimination, it starts with the pre-exam process. Examiners do an evaluation of your data, your policies, procedures, marketing, complaints, past exams, but especially the data. And they fill out a fair lending examination memo to determine whether or not redlining should be a focal point of the examination. And as an example, the FDIC scoping memo is public information, and I highly recommend downloading it and implementing its use. And if you're at an institution where there are numerous redlining risk factors, then it is very likely going to be a focal point during the exam. And it's critical you have the answers and action plan for examiners when they ask you to explain why and what the cause is for the appearance of those risk factors. At the end of the day, if there's no reasonable explanation as to why your data says what it says, then most likely the best case is the exam will have at a minimum numerous costly recommendations. And worst case is there could be a referral to the regional or Washington office and possibly DOJ referral, which will result in millions of dollars to fix the problem. So for some takeaways, REMA and redlining, delineate your REMA and understand its demographic and economic profile. Conduct a redlining risk assessment on the REMA. Review policies and procedures for redlining risks. Make sure there's no verbiage that differentiates on geography. Conduct comprehensive data analysis. Review marketing strategy. Where is your focus? Conduct branch, LPO, and loan offer geographic territory analysis. Compare your data to similarly situated lenders and demographic data. Determine if you're an outlier. Document findings and business reasons, and be ready to defend them with the examiners. And delineate your assessment area and your REMA, and look at those borders. And evaluate lending patterns on at least an annual basis, if not more frequent. So in conclusion, I sound like a broken record, but define your REMA and document business case and reasoning for the definition of your REMA. Document all business decisions that went into the definition and be ready to defend what it's saying. A well-developed REMA description and understanding of the institution's lending patterns and comparative analysis of similarly situated institutions will ensure knowledgeable and effective conversations with your examiners when a fair lending review is being conducted at your institution. And have an action plan. If you identify risk factors that are not reasonably explained away, have a plan to address improving and removing those risks. And document to examiners corrective action. The last thing you want is a lack of a deep understanding of your REMA when confronted by examiners questioning that you're at an institution that has been identified as an outlier. Well, that concludes my portion of the presentation. At this point, I'd like to pass things back over to Heather for part 2 of the presentation. Heather?
Thank you, Rob. Wow. Thank you so much for that too. That was some really great information on how to conduct your own risk assessments for redlining and determining your REMA. So let's dive in now to discussing mortgage loan default management practices and the ways in which you can conduct similar assessments on your collections efforts. So in this segment, I will first highlight to you the importance of why you should have a strong understanding of your collections policies and procedures, even if you don't manage a large portfolio of delinquencies. Beyond that, I want to get you thinking about some of the key attributes that you may wish to re-review on any accommodations that you offered for COVID-related hardships. We'll also talk about some best practices for the loss mitigation process and highlight recent GSE and industry changes. Finally, we'll wrap things up with some key considerations for optimizing your operations and what steps you can take today to set yourself up for success. Now, you might be saying, well, we don't have high delinquency rates, or we have a very low number of delinquent accounts, so this really doesn't concern me. And you're not alone. A March 2023 Loan Performance Insight report presented by CoreLogic measured the delinquency rate of mortgages 30 days or more past due at just about 2.8% in January of this year. And that demonstrated about a 0.5% decrease in defaults from the prior year, which is great news for servicers. But whether or not you have one loan or 100 in collections, the same rules apply, and the same level of scrutiny will be applied as well. Your procedure manuals and supporting forms and docs are all reviewed for potential UDAP concerns. Even if unintentional, any part of your decision-making process for determining eligibility for loss mitigation workout options that could be construed as discriminatory will be called as such, and you do not want to find yourself in the position of needing to explain your way out of something that was not purposeful from the start. Auditors will ask themselves as they review your policies, is there evidence of a mechanism in place to monitor and prevent unfair, deceptive, or abusive acts and practices? And this does not only apply to your internal staff members, but it is extended beyond to any third-party players involved in the collection process. Perhaps you refer loans to a local attorney's office. You are responsible for their actions as well, ensuring no differential treatment or disproportionately adverse impacts on a discriminatory basis. How do you or these third parties communicate with borrowers having limited English proficiency? In early May of this year, the FHFA announced the GSE requirement for use of the Supplemental Consumer Information Form. This provides for voluntary submission of a borrower's preferred language. So perhaps you have that on some of your newer loans, but what about loans more seasoned in your portfolio? How do you determine their primary language preference? And what do you do when their response includes a language in which you are not fluent? Now, there are resources available for translated tools and documents to assist servicers in helping borrowers with limited English proficiency. If you haven't familiarized yourself with resources like mortgage translations, please reach out to us and we can point you in the right direction to get yourself acquainted with the FHFA or GSE website tools. Another fundamental aspect of managing collections is the documentation that you maintain. Every interaction or attempted outreach should be documented and properly stored. Now, ideally in such a way that it's easily extractable for auditing or legal tracking purposes. And as many of you know, there are very strict rules as it relates to your methodology and the timing when it comes to reaching out to borrowers. So be sure that you're in compliance with all of the various acts and practices and state or federal laws that may trump one another. Earlier this month, we saw the COVID-19 national emergency and the CARES Act protections both expire. For many of you, the hardship loans that you offered because of these protections accounted for probably the largest portfolio of accounts ever managed by your collection or loan servicing team at once. And for a period of time when this all began, there were certainly challenges in how to properly offer these payment relief options. The CARES Act called all COVID-related hardships placed in forbearance or offered a deferral an accommodation. Now, these accommodations came with rules for the servicers, and many of these were really evolving at the same time you were proposing them to customers. Programming teams for core platforms were building the product offerings and automations to pair with them at the same time that the rulings were being made on how they should be structured. And all the while, servicers were actively offering forbearance agreements. Some of you were making offers without knowing for sure how or if the servicing platform was going to be able to handle it all. But once the guidance was solidified, programming updates were completed, the expectation was that all loans were reviewed to ensure full compliance and complete accuracy. So what types of things should you be looking at with this portfolio of loans? Well, things like checking that they were properly documented with start and end dates, that deferred amounts matched, credit reporting was done correctly, that receivables and late charges were properly inactivated are all great places to start. Did you recognize at the time that this was a triggering event under flood and obtain a new flood cert? With so many moving parts, it's really not hard to imagine a scenario where something was overlooked. And we've seen it happening with our clients where we've helped them to work on these types of reviews. And in those cases, we were able to document the deficiencies and provide guidance on best practices for addressing them instead of having them be blindsided by an exam finding or worse, a customer complaint. The CFPB recently made updates to the Mortgage Servicing Examination Procedures Guide just in January of this year, and those updates specifically discuss forbearances and other loss mitigation options extended to borrowers experiencing COVID-related hardships. So this is certainly not a topic off the radar just because the national emergency has ended. Actually, just about 6 months ago, we learned about an action that the CFPB is taking against a mortgage servicer who they claim not only charged improper late fees, but also inaccurately reported the forbearance status to the big three credit reporting agencies. Now, as penalty, they are required to repay any late fees that were not already refunded, to revise their procedures and their general business practices, and to pay a fine of over $5 million for a victim relief fund. This is unfortunately a very harsh reminder of how costly even an inadvertent mistake truly could be. Let's transition now to talking a bit more generally about your collections process and procedure. Proper collections procedures should include establishing QRPC, or Quality Right Party Contact. This will help you determine some of those key factors that for GSE-owned loans you'll eventually need for reporting, but even in the case of a portfolio loan, you'll need to understand the reason for the delinquency, whether or not it is expected to be permanent or temporary, and what your sense is about their commitment to resolving the delinquency. All of this will help to guide you in determining eligibility for workout options. State collection guidelines restrict certain levels of contact, again, even if unintentional. More than 2 calls to a person's home in a 7-day period, or more than 2 times in a 30-day period to a place other than a home is prohibited under Mass Fair Debt Collection laws. So training your staff and ensuring your procedure guides instruct them on proper outreach techniques is really critical here. It's important also to deliver the mortgage assistance application to your borrowers. This is a helpful tool for you to collect more detailed information as it relates to their financial situation, to again help determine eligibility for workout options. Typically, your investors are requiring this to be mailed out by the 45th day of delinquency, and it's typically common practice to apply the same logic for portfolio loans. As part of collecting that detailed information, you want to ensure you're inquiring about military status as well to see if the borrower qualifies for any service member reliefs. Keep in mind with SCRA, the protections apply not only during active duty, but for an additional year thereafter. Even if you have achieved that quality right party contact, it is so important to deliver that right to cure letter in a timely manner. This essentially starts the clock for any foreclosure actions, which cannot happen until after that cure window expires. Now in Massachusetts, if you've already provided that notice to your borrower on the same property in the last 3 years, you are covered under safe harbor and do not need to deliver it again in order to accelerate to foreclosure proceedings, which is something else to keep in mind and really just another reason for me to stress that importance of tracking and documenting all of your actions. Property inspections often arise question as well when it comes to understanding what is required and how often you need to complete them. You want to pay attention to your specific investor requirements around the use of their forms to ensure you collect the proper pieces of information. and when this process should begin, as well as the frequency in which you're required to repeat inspections depending on the loan status. So ultimately, the goal of your workout process is to establish a resolution that keeps your borrower in their home and brings the debt current where they continue to satisfy their monetary commitment to your institution. Now, each investor will walk you through their own hierarchy, and typically you'll utilize their portal for entering loan level information to evaluate the applicable workout options. You'll likely have similar workout offerings for your portfolio loans, and you'll want to make sure, again, that your procedure documents and any supporting worksheets for establishing eligibility are clearly established and followed to, again, ensure no disparate or differential treatment in the decision-making process. Now, it's no secret that managing a collections operation has many complexities, especially when it comes to loans that you service on an investor's behalf. I'm sure most of you are receiving investor bulletins, lender letters, and announcements. If you are not, it's certainly something that you should subscribe to directly. And I know firsthand it can feel like a full-time job just keeping up with the influx of these news items, trying to determine what's relevant to you and what's not. So I'll take a minute here to highlight a few of the more recent investor news items that may be helpful to you. Fannie Mae's Lender Letter 2023-04 highlighted the expansion of their regular payment deferral workout option to begin July 1st, this being in response to the expectation that servicers continue to offer streamlined deferrals and modifications wherever applicable now. They have also restructured their workout hierarchy in the lender letter and within their guides. So if your procedure documents don't already refer you out to the investor guide for the latest info, it would be a good idea to review these changes. Lender Letter 2023-03 talks about the property preservation and property inspection guidelines and refers you now to a separate matrix that they've created as a reference document. Updates here also included some increases in expense reimbursement limits that you may be interested in exploring. Freddie Mac has also released a few bulletins, the most recent being 2023-08, which relates to their expanded payment deferral workout option, retiring the need for it to apply only for COVID-related hardships. Also, you should be aware by now that their default eligibility processing portal is changing over from Workout Prospector to Resolve. Many functionalities are also available already in Resolve, and more are to come throughout the year, so make sure you're keeping an eye out for more changes as that continues to move forward. Some of you also may have relationships with MPF, perhaps for their traditional or their extra program. So here are just a few of their recent announcements as well. MPF announcement 2023-31 was just issued on May 4th, and that announced their official retirement of the initial 90-day forbearance period for COVID-related accommodations. Same as the GSEs, and again, all of this being in response to the CFPB's dictation for servicers to continue providing streamlined loss mitigation options that were established with COVID, even in this post-COVID world. It also discusses the removal of the CARES Act protection, which reminds you that you'll need to pay attention to how your system is set to handle credit reporting and late charge protections, as that's now all different than it was with COVID loans. In announcement 2023-28, we saw their guides update really to just align with Fannie Mae requirements around achieving quality right party contact and the timing and frequency of such outreaches. So MPF Extra servicers are going to be following Fannie Mae guidance. Their announcements typically just mirror those found in the Fannie Mae guides, but it can serve as a really nice reminder or a refresh to ensure that nothing is overlooked. So when it comes to collections, it can feel pretty overwhelming to maintain confidence that you're properly managing it all. If you fail to deliver a notice in a timely manner, or if you slip up on documenting some form of communication you made with your borrower, your entire roadmap can change. So what sort of actions can you take now to reaffirm confidence in your collections process? A great first step would be to review your current process with a self-assessment. What actions are your collectors taking on a regular basis, and what guides them as they work with these borrowers? When was the last time this process or any of the supporting documents were reviewed? This is something that should be looked at regularly to certify that what you have in place is sound, compliant, and meets the wide array of needs coming from each of your investors and the regulators. A lot of our clients are capitalizing on the opportunity during this lull in the market to have us review or reestablish these types of procedure documents that were either stale or non-existent for them previously to better position themselves down the line. So when you review procedure documents, you want to also pay attention to those supporting docs that they reference. Your job aids, your worksheets, those tracking logs, all of the tools that provide you with structure for uniformly applying your policies. Are you relying on Excel spreadsheets or Word documents for taking notes and tracking progress? Perhaps you want to explore a collections management system that integrates right with your core. Even if you don't have a big budget for technology, you could consider programs like Smartsheet that may bring you some level of automation and reporting capabilities without the bulky price tag. If you're up for considering some alternative solutions, let's not forget about the opportunity of contracting with outside vendors to work on your behalf. Perhaps those property inspections could be done by an appraiser or an inspector with whom you already have a relationship. SCA has experience facilitating relationships between clients and legal offices that specialize in collections. These types of relationships have been helpful in a lot of different scenarios. For some, it was because the need for such specialized knowledge was so infrequent that it was more worthwhile to have those accounts handled externally and know that legally everything was handled properly. For others, it was due to staffing challenges that really limited their internal abilities to manage these tasks themselves. Now, none of what we see is a one-size-fits-all approach, so whatever your appetite is for managing your collections process, the team here at Spillane Consulting can help to guide and advise you on what might be the best fit for your specific needs. So we welcome the opportunity to provide any further insight as you may wish. And with that, we've concluded the second part of our presentation today, and I'll pass things back to Rob to wrap things up. Rob?
Thank you, Heather. And that is some great information and certainly a lot of food for thought. And as we mentioned at the beginning of this presentation, we are sharing our contact information here should you have any follow-up questions or want to reach out to us directly. We have also included Bill Dolan, our Director of Sales, contact information. And a copy of this presentation will be emailed out to all attendees as well. We thank you all for joining us today. And as always, we here at Spillane Consulting Associates welcome the opportunity to assist you in any way. So do not hesitate to reach out about a topic discussed today or anything else you may want to hear from us about. Thank you again and take care.
Thank you.